Meta Platforms has initiated a dividend. Is this now continuing to be a great growth stock at a reasonable price? A great dividend growth stock, a future dividend growth stock star? Either or all of the above. Which is the right story? Watch this video to find out. Hello, everybody. This is Chuck Carnevale, co-founder of Fast Graphs, the fundamentals analyzer software tool, a.k.a. Mr. Valuation. Got a really interesting video today. We're going to be looking at Meta Platforms, Inc., a.k.a. Facebook, after they initiated their first dividend and had a real powerful surge the first day. And of course, things have settled down a little bit. But what this video is going to attempt to try to ascertain, ask, and maybe even answer is now, are we looking at a growth stock, as Meta has always been, Facebook has always been? Are we looking at a really powerful dividend growth stock? All of the above, none of the above? Is this now still growth at a reasonable price? Let's take a look at Meta and run it through the paces of Fast Graphs and see what we can discover. And then we're also going to have our special guest, Professor Nathan Mauck, who actually has written papers on companies that initiated their first dividend and what the results and what the future might look like as a result. So that'll be later in the video. Let's go ahead and get into Meta now using Fast Graphs. The first thing I want to point out is if you look at Meta's history going back since they went public, back in 2013, and I'm going to take the price off the graph here for a moment, the normal PE. The company really had a great earnings history with some really powerful earnings growth rates, 66%, 101. This was really a quintessential growth stock at this time. And then, of course, coming into COVID, they did have their first hiccup. But then coming through COVID, they really began powerfully growing earnings again. And then 2022 saw a rather significant drop in operating earnings of over 38%. Now, this can be attributed to the fact that, first of all, they had a 22% increase in expenses, which included a $4.2 billion restructuring charge in 2022. Their free cash flow fell even more due to a 66% jump in CapEx. And for the full year 2022, ad revenues did grow 4%, which was, obviously not real high considering their history, but fell 1.1% when you include currency. So net income and earnings similarly fell by strong double digits because of a 23% increase in expenses, which included that $4.61 billion of restructuring. And even more important, free cash flow was halved. Now, that brings me to this next statement. If you're going to utilize Fast Graphs, it's very important that you utilize all of the metrics that Fast Graph makes available. If I go up here into the metrics section and hit the drop down, we can look at basic earnings and diluted earnings, and we see the effect that basic earnings fell and diluted earnings also fell. Again, remember the restructuring charges. But even more importantly, now that this has become a dividend-paying stock, and you can see they've initiated their dividend, it's 50 cents a share, $2. We're not growing it here because this is obviously too soon to do any, estimates of future growth, but we are going to talk about the potential for that in this video. But I do want to point out that operating cash flow is expected to grow strongly. And even more importantly, now that it's a dividend-paying stock, let's look at free cash flow. Now, free cash flow was more significantly impacted even than operating cash flow, as I previously mentioned, because CapEx jumped 67% to $32 billion this year. But look at the recovery in free cash flow for 2023. And then, of course, this might even partially explain the idea that they decided to launch a dividend because they've got billions of dollars in cash, very low debt, 18.95% debt to capital. They are AA rated. And of course, they are a $1 trillion market cap company now. But I want to point out that you want to utilize all of these metrics. I also want to look at it from a standpoint of EBITDA. EBITDA was less affected, earnings before interest, taxes, depreciation, and amortization. EBIT, which is earnings before interest and taxes, performed a little better. And then, of course, if we look at the all-important revenues, we see that revenues did continue to grow and grow rather nicely. Now, let's bring in weekly closing stock prices into all these metrics. And I do want you to see that even though revenue grew, although it did slow down to only 5% growth, the stock price fell dramatically in 2022 before its recent recovery. That's looking at it from a sales point of view. Looking at it from an EBIT point of view, the stock price correlated more closely to EBIT, but again, we're seeing the strong rally. Going through EBITDA, it also grew. And I wanted to point out that Meta Platforms, based on the max time frame, looks undervalued on that basis, on the basis of EBITDA. And then, of course, if I look at free cash flow, it looks more fully valued, or fairly valued might be the better way of saying it. And then operating cash flow, it looks very, very undervalued. This company does generate a lot of cash. I'm going to skip the other earnings options and go into the adjusted operating earnings. Now, based on their historical growth rate of 32%, obviously, Meta now looks like it's fairly valued, or just maybe slightly above the orange line. The orange line on the fast graph represents a theoretical fair value, and that is obviously driven by growth. In this case, we're looking at 32% growth, and we've maxed the PE ratio out at 30. So we've got an orange line here as a PE ratio of 30. We just maxed that out as the highest valuation that a company ought to sell at. But here's what I want to make the point. When you use this tool, you need to use it appropriately, okay? And the first thing you should do is start trimming time frames. And what I want you to focus your eyes on is the growth rate, the adjusted operating earnings growth rate. Now, when I use the max time frame, it's 32.03%. If I drop it to the 13-year time frame, which starts in 2014, growth rate drops down to 29.72. A little bit lower, but not really too much. I drop a couple more years off and drop this to a 10-year time frame. Now, all of a sudden, I see that growth has fallen to 19.87%. And here we're still using the P equals growth rate formula as a valuation reference. And at this level, we're saying a fair value PE is 19.87. We adjust according to the growth rates. And at that point now, Meta would start to look like it was slightly overvalued. But even though it's overvalued here, or appears to be overvalued here, does not mean that it won't generate a positive rate of return. If it did grow as expected and it traded at we'll call it a 20 multiple here, 19.87 multiple, you'd still be able to make money. Valuation is all about participating fully in the growth of the company, and more about that in a moment. Drop it down to 7 years, and now all of a sudden we've got earnings growth at over 22%. Now, people say, well, geez, every time you change the fast graph, the lines change and the valuation rate. Of course they do, because you're measuring different rates of growth. And this is the Fundamentals Analyzer software tool, Analyzer. You want to analyze what's going on with the company. So we're seeing different rates of growth here. Now I drop it down to the 5-year, which includes 3 years of estimate data currently, or, not quite full 3 years, but pretty close. And now we have a 13 multiple, and we're using the 15 multiple as our valuation reference line here. Okay, but the point is, Meta's growth has slowed, but yet going forward, it's expected to continue to slow to 16% in fiscal year 2025. And then 13% in 2026, but it is expected to grow at 33% this year. All right. Now that could imply a higher valuation with the PE, roughly at 29.9, or we'll call it trading roughly at 30 times earnings. Then, that would be more in line with valuation of a 30% growth rate. So I do want to point that out to you. All right. Now, if I go through this again, and I'm going to use the 10-year number here as kind of a good growth proxy. If I go through looking at operating cash flow, it looks very undervalued. If I look at free cash flow, it looks very undervalued. And the fact that the company is now paying a dividend is very, very important. And of course, I look at EBITDA, the stock looks like it might be, just above its fair value line, but yet still capable of generating some very strong rates of return even for this year, over 40%. Even though it's technically a little above the line, it's still given us a lot of growth potential based on looking at it from EBITDA or EBIT. It would look a little pricey again. And then, of course, from the revenue side, on the price to sales side, it's trading at a blended price to sales of 8.78, and it's historically traded at 8.6 times sales. Historically over this time frame, if I expand it out to the max, it's actually traded at almost 11 times sales. So somewhere between 8 and 11 times sales has been historical norms for Meta platforms. So that's kind of interesting. All right. We've looked at the company from a lot of different scenarios here and the different metrics, and we've also looked at it from a lot of different time frames. If you're a subscriber to Fast Graphs and you're not running every historical graph through multiple time frames, you're not using the tool properly, because one of the best advantages you got is it allows you to analyze what's happening to the growth going forward. But now that leads me to forward growth. That's obviously, I always say you learn from the past. And I do want to point out, Meta is a classic example of how earnings drive market price. And we can see that, the stock price reacted to earnings growth very, very beautifully here. And at times when it got undervalued and below the orange line, and there are people that just really can't ever get this into their head, at this point, the stock was worth, 227, and it was trading at something around 135-ish. And then, of course, that led to, growth. Even though we had a down year, the stock still did recover. And then we came into COVID. We had a little drop, but then the stock recovered again. And then we had the bad year in 2022, and the stock price reacted to that. And then we had the strong recovery year, and once again, the stock price reacted to it beautifully. In fact, buying a stock when it's undervalued like this and everybody hates it, would have been an opportunity to generate a 230% annualized number from February of 2024 to October of 2022. Now that's an annualized number. The actual growth, almost tripled your money, over tripled your money, 363%, but a little bit over a year's time frame. Now, but let's talk about the future. Okay, let's go into the forecasting graph here, and let's look at the future. Now, there's some very interesting metrics here. We're looking at a very high growth rate expected to 2024 on earnings, over almost 33%, as I indicated earlier, coming off of 73% last year. But then 49 analysts expect it to drop to 16% and then to 13%. But by the way, they've been raising the estimates all along here. From 6 months ago, it was they were expecting $19.50 in 2025. Then they went up to $19.97, then $22.87, and the most recent estimate now is $22.90. So I do want you to notice that the analysts are getting more positive. On a 1 year forward and 2 year forward, the company does have a very good scorecard, but they do have 18 to 20% misses on the 1 and 2 years. So take that into consideration. But here's what's interesting. The long-term growth rate for earnings of the company is expected to be 25%. Which would indicate that this is still a very, very attractive investment, even though it's on the high end of the valuation corridor demonstrated by these, 5 orange lines here, the dark one, 2 above and 2 below. That's your range of, error. If it traded at a 25 multiple and it's currently trading at a 30 multiple, then you would make 22% a year annualized. So Meta platform still looks like it has great long-term growth opportunity ahead of it. And so it looks very, very interesting. But here's the real key. Let's talk about the dividend. What can we expect to happen with the dividend? Well, Professor Nathan Mauck, who is a consultant to Fast Graphs and works with us on many aspects of the tool and development of the tool, actually has done research papers on what happens when a growth stock or a growth company initiates their first dividend. What can you expect going forward? And he's going to present and talk about not only Meta and what its possibilities might be, but also he's going to show some examples of some other very high-profile growth stocks that began paying their first dividend and what it all means and what it could indicate for future growth. So let me turn it over to Professor Mauck.
So Meta Platforms, the parent of Facebook, recently announced a dividend. So the first time they're going to be paying a dividend. That shows up on the fast graph here. You can see that the estimated payout is $2. That's annualized, so it's a 50% quarterly dividend, annualizes to 1. And I want to talk a little bit about, not to get too academic, but I can't help myself, about dividends and payout policy and what maybe this tells us about Facebook. So, first of all, it's kind of a good problem to have when you've got more cash on hand than you know what to do with. But that is generally what triggers payout, is firms with excess cash don't see opportunities to invest all of that cash to continue investing in profitable projects. And so they decide to pay some of that excess cash back out to shareholders. That's sort of what we would want them to do, but it can be a little bit of a signal that maybe growth is slowing and that a firm is maturing, and maybe there aren't as many opportunities for investing those funds as there were before. So to the good, firms don't really start paying dividends unless they're pretty sure they can keep paying those dividends. So it tends to be a signal of stability, quality earnings, and faith that they can continue those quality earnings and keep paying the dividend. To the flip side, it can be a sign of lower growth. And certainly if you look at Meta's historical growth, that's a 32% growth rate over this period. If we look at especially at 25 and 26, still a healthy growth rate, but not to that 32% standard that they've set. So combined with the analysts' projections and the payout, does seem like a sign that Meta is entering a relatively lower growth period than they have been historically. So when a firm pays dividends for the first time, oftentimes that's more informative than even a dividend increase for a firm that's already paying dividends. So it's a pretty big change to switch from a non-payer to a payer. And I actually have some research on this very topic, co-authored with my mentor and frequent co-author, the late, great Bong-Soo Lee. But we wrote this paper on dividend initiations, increases, and idiosyncratic volatility. And the punchline is, although in theory, a firm initiating dividends, paying dividends for the first time, is a signal that they might be relatively less risky, more stable. There wasn't really a lot of research to support that, and so that's what we looked at in this paper. And we did find that after firms initiated dividends, their idiosyncratic or firm-specific risk declined. So it did seem to signal, on average, that firms were entering, a relatively less volatile period of time. The other thing that I might mention is that, dividends are a part of a larger payout process. So in addition to paying dividends, you can also repurchase shares. So when a firm has excess cash, they have that option. And if you look at the most recent announcement from Meta, they repurchased $20 billion worth of shares in calendar year 2023. So they're doing a lot of repurchasing, and still, compared to the amount of dividends they're paying, still doing more repurchasing. So I'm going to hop back to fast graphs here, and we'll just kind of remember that $2 annualized, and we'll go to their financial statements. And in their income statement, we see they have about 2.5 billion shares outstanding. So at about a $2 dividend, that's about $5 billion. So you compare, maybe $5 billion in dividends to they spent $20 billion on repurchases in 2023. It'll be interesting to see if they continue repurchasing at the same level, or if the dividends eat into the repurchases, or they're just going to pay out more in general. So we kind of want to look at total payout together. The market usually reacts well to dividend initiations. When a firm pays dividends for the first time, this paper of mine found about a 2.5% bump the day it's announced compared to how the market did. But when Meta announced, this is an article from Reuters, but up 14% after the bell. So the market reacting very favorably to the Meta announcement. We find that usually the reactions are stronger in those cases where firms have had maybe a more volatile stock price historically, or when it's a stronger signal that the volatility, the risk of the firm is going to be going down. Another thing I wanted to mention is, if you look at this on the fast graph that says, estimated payout about a 10.1% payout ratio. So paying out about 10% of their earnings in dividends. That's a healthy payout, but certainly leaves room for upward growth in payout ratio. Not to say they necessarily would, but that possibility exists. If you compare this to, for instance, Apple, when they initiated their dividend, was at about a 6% payout ratio. That jumped into, at times, the high 20s. They're at about a 15% payout ratio. Or if you take a look at a firm like Amgen, as they sort of exited their higher growth period and entered their lower growth, they started too at about this 10%, and now they're all the way up to a 46% payout ratio. You also see their growth rates have slowed a lot. So typically those things are related. If Meta continues to have a lot of growth opportunities, they might keep spending. If there are fewer, we might see that payout ratio increase. So, kind of an exciting time, an exciting inflection point. And again, in general, starting a dividend tends to signal a firm might have fewer growth opportunities, but also is entering a less risky, more stable earnings sort of life cycle of the firm.
All right, Nathan, thank you very much. That was excellent. And really gave you some insights into what might be going on with Meta Platforms. Now, let me point out, we're talking about speculation here. We don't really know what to expect. But let's look at Apple, and let's look at what happened to Apple after they initiated their first dividend. Now, Apple's another good example of how you must run, different time frames. It had a long-term history of growing at 39%, but I shortened the time frame to just before they started paying a dividend, and the growth rate was now only 14%. So what happened was this powerful growth stock then morphed into a dividend growth stock, and it paid its first dividend in 2012. So let's go ahead and go into the performance report. It, like Meta, started out with a 0.69% initial dividend. Meta currently offers a 40.42% dividend, the $2 a share current rate. Again, we're real trying to figure out what their dividend policy would be. But the payout ratio at that point was only 6%. They were only paying out 6% of their earnings. But the next year, Apple increased their payout ratio to 28% and then stayed in the 20s, and then it's been more recently back in the teens. The point is the company's still growing and they're still paying out a very small portion of their earnings. But this is the powerful part. Apple became a 37, almost 38% average dividend growth increases. But again, that includes a very high, first year number. So let's cut that down to 13 years, and let's look at what I would call normal growth. And it's been actually growing at about it's been growing their dividend at about 8.5%, almost 9% per year. Now, let's also take a look at Amgen, which was another one that Professor Mauck talked about. Let's look at what happened to Amgen. And once again, let's go to the historical graph real quick, and let's, run this out to where they started paying their first dividend. And you could see a 56-cent dividend, but then it immediately more than doubled, almost tripled after the first year. So looking at the performance report on Amgen, they started out paying 1%. Their yield on cost last year was 15.52. Once again, a very high dividend growth rate, but it's contaminated by that first year. So let's cut that out and let's look at normal dividend growth. And we see that it's been growing at about 17.86% per year average, 17.54% compound average. The dividend has increased dramatically. Went from $1.88 to $2.44 to $3.61 to $4, $4.60, and so on and so forth to fiscal 23. They paid $8.53. All right, so the point I'm getting at is companies that start paying a dividend that were previously growth stock all seem to follow the similar pattern, and Professor Mauck talked about that. We could say the same thing again if we look at Orcl Corporation, looking at their historical earnings growth. They initiated their first dividend in 2009. Very modest nickel a share. Then they quadrupled it, May ending fiscal year 2010 to 20 cents. And then it was some kind of slower increases in growth. But if we look at Oracle's long-term history, they started out only paying 0.22%. Their payout ratio was only 3.5%, but then it went to 12 and stayed in the close to double-digit range, and now is up in the mid-20s range as time goes on. And once again, you can see the yield on cost grew dramatically. Once again, getting rid of that exceptional year, their average dividend growth rate has been about 16.64%. So it is not unusual to see companies that were once very powerful growth stocks, once they started paying a dividend, they start out kind of tipping their toe in the water, which is what Meta's doing. They're paying 50 cents a share, and that's given them a 0.44% yield based on the current value as of yesterday's close. The real question is what's going to happen going forward. Now, the company has, a tremendous, as Nathan talked about in his part, they spent more money on share buybacks, but now they've initiated a dividend and they have so much cash and so much cash flow that, what's the company going to be doing with their dividend policy going forward? Well, I think, if you're a kind of an aggressive investor and still like growth, I think this company still offers that, and it still offers growth at a reasonable price. But now we've got this dividend kicker, and we're still in the early stages of trying to ascertain what their dividend policy might be. And based on that, it could be a powerful dividend producer going forward. This could be the next great dividend growth star, where, you could be earning 2 or 3 or 4% yields on Meta, especially if you bought it today while the stock, was still attractive. Of course, it was a much better buy, obviously, a year ago. And, I like to point this out because everybody was talking negatively about Meta platforms back then, but that turned out to be obviously one of the best times in the world to buy this stock is when they were having some operational issues in 2023. That did lower the stock price dramatically, but then they came back with a vengeance in 2023 and are expected to have another great year in this current fiscal year, 2024. And then they're still expected to have some good growth years going forward. So, they've obviously gone into AI and some other issues here that have given Meta an opportunity to grow again, even though they're already a $1.1 trillion company. There is some speculation here in terms of, how much growth the company can achieve going forward. But the quality is great and the dividend is great. And, maybe the worst thing that might happen to you if you bought the stock today is that it becomes the next, future dividend aristocrat or dividend growth stock star going forward. Anyway, that's our take on Meta and after they've initiated this dividend. This has been Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. Thanking you for watching. Hope you enjoyed it. If you did, give me a like, subscribe to the channel, and take a look at FastGraphs. More and more we're developing this tool out to help it make you, as an investor, be able to make smarter, more prudent, safer, and more learned long-term investment decisions. Thanks for watching, and we'll talk to you again real soon.